Hey everyone, Fred here from Simple Weekly Trading. If you're looking for a straightforward way to build long-term wealth without the daily grind, this is for you. Today, I'm sharing a simple weekly chart trading system focused on SOXX, the iShares Semiconductor ETF. This is all about discipline and compounding. No fancy indicators here, just simple rules to capture major uptrends while keeping your risk low. Let's dive into the why behind this system. First, why use weekly charts instead of daily? It's about simplification and better results for patient investors. Weekly charts filter out the noise. They filter those short-term dips that stop you out too early on daily setups. You get fewer signals, but they are much higher quality. That means less time staring at screens, just check once a week, and significantly lower emotional stress for you. Backtests show weekly systems often have drawdowns 30 to 40% lower than daily, while still capturing 80 to 90% of the gains. The system is long-only, trend-following, and strictly rules-based. Here is the breakdown of a trend filter. Trend filter. Only trade if the weekly close is above the 200-week simple moving average. This keeps you out of dangerous downtrends. Entry. Buy if the weekly close breaks above the 30-week highest high. We use the Donchian upper band for this. Stop loss. Your initial stop is at the entry price minus 2.25 times the 14-week average true range. It's adaptive to volatility. Trailing stop. Ratchet your stop up to the highest high minus 5.5 times ATR. Only move it up, never down. Exit when hit. Position sizing. Risk a fixed percentage of your account per trade. We will cover the 1, 2, and 3% options in a moment. Execution is simple. Check your charts at the end of the week and enter or exit at Monday's open. No midweek stress. Why focus on SOXX? It tracks semiconductors, the backbone of tech, AI, and global innovation. It is a proven long-term winner. By concentrating on one strong ETF like SOXX, you maximize compounding. Discipline beats diversification when you pick a sector with strong tailwinds. But these rules are universal. They work on Bitcoin, gold, any trending stock or ETF, basically anything that trends. If it trends up long-term, the system captures it. Now, the real power, compounding. This system lets winners run huge while cutting losers small, creating a powerful edge. CAGR is the key metric. It shows how your money grows exponentially. At a 20% CAGR, your money doubles every 3.5 years. At a 40% CAGR, it doubles every 1.8 years. The system amplifies this by riding the bulls and staying in cash during bear markets. Higher risk per trade means larger positions and higher CAGR, but also bigger drawdowns. Always match the risk to your personal tolerance. Looking at our 10-year backtest starting with $100,000, at just 1% risk, your final equity grows to $1.75 million. At 2% risk per trade, that final equity jumps to over $3.4 million. That's a 41.5% compound annual return. And at 3% risk, the results are staggering, growing to $6 million over a decade. These are simulations, but they show the potential. At 2% risk, you triple the returns of a simple buy-and-hold strategy, often with half the maximum drawdown. This is for anyone seeking simple wealth building with discipline. No get-rich-quick schemes, just consistent execution week after week. I encourage you to paper trade this system first on SOXX. See how it feels to follow the rules without the emotional pressure. In our next video, I'll walk through the exact TradingView setup, how to set your alerts, and historical examples step by step. So make sure to like, subscribe, and hit those notifications so you don't miss that lesson. Let's build that wealth together. See you in the next one. And remember, this is not financial advice. Trading involves significant risk. Always trade responsibly.